Welcome to the award-winning Consumer Finance Monitor podcast, where we explore important new developments in the world of consumer financial services and what they mean for your business, your customers, and the industry. This is a weekly show brought to you by the Consumer Financial Services Group at the Ballard Spahr Law Firm. And I'm your host, Alan Kaplinski, the founder and former practice group leader for 25 years, and now senior counsel of the Consumer Financial Services Group at Ballard Spahr. And I will be moderating today's program. For those of you who want even more information, don't forget about our blog, consumerfinancemonitor.com. We've hosted the blog since 2011, so there's a lot of relevant industry content there. We also regularly host webinars on subjects of interest to those in the industry. So to subscribe to our blog or to get on the list for our webinars, please visit us at ballardspahr.com. And if you like our podcast, please let us know about it. You can leave us a review on whatever platform you use. Also, please let us know if you have ideas for other topics that we should consider covering or speakers that we should consider inviting as guests on our show. Earlier this month, on April 12th, we hosted an in-person event in our Washington, D.C. office, where my colleague, Adam Maarec, sat down for a wide-ranging and thought-provoking conversation with Simon Taylor, who is the founder of Fintech Brain Food and Fintech NerdCon. And he's one of the most insightful observers of global fintech trends. Because of the success of this event, we decided to share a recording with our clients and friends on today's podcast show. Before turning to the discussion, let me introduce Simon and Adam. As I indicated, Simon is the founder of both Fintech Brain Food and Fintech NerdCon. He's been immersed in the technology of financial services for as long as he's been working and has consistently voted one of the most influential people in banking, insurance, and fintech by banks, his peers, and a number of industry bodies. Simon runs Fintech Brain Food, which is the weekly newsletter subscribed to by over 45,000 people at banks, fintech companies, and VCs. A regular speaker, media presenter, and podcaster, Simon has spent 2 decades in financial services involved in payments, banking, crypto, and consulting. Fintech NerdCon is a niche, insider-oriented annual fintech conference focused on meaningful networking and practical learning, more builders talking to builders than a traditional industry trade show. Simon is now focused on bringing payments on-chain at Tempo, the payments-focused blockchain incubated by Stripe and Paradigm. Simon's specialties include, among other things, embedded finance, blockchain, crypto assets, fraud, cryptocurrencies, fintech, finserv, digital strategy, digital compliance, digital operating models, user experience design, service design, mobile banking, personal financial management tools, e-commerce, and online proposition development. My colleague, Adam Maarec, is a fintech and consumer financial services attorney in our Consumer Financial Services Group at Ballard Spahr. His practice sits at the intersection of traditional banking and financial innovation. He advises banks, fintechs, and payment companies on a wide range of products, from deposit accounts and credit cards to digital wallets, embedded finance solutions, and open banking initiatives. Adam regularly works with clients on regulatory compliance, product structuring, and commercial arrangements, including bank fintech partnerships and emerging data access models. He has significant experience with CFPB regulations and policy developments, including Section 1033 of Dodd-Frank. And that's the open banking section. And he brings a very practical perspective shaped by his prior in-house roles supporting digital banking and technology teams at major financial institutions. Adam is vice chair of the Electronic Financial Services Subcommittee and Digital Currency of the Consumer Financial Services Committee of the Section of Business Law American Bar Association. He's also a member of the Emerging Payments Advisory Committee of the NACHA Payments Innovation Alliance. And he is a newly elected fellow of the American College of Consumer Financial Services Lawyers, an honor which is bestowed only on lawyers who are the most preeminent in the field of consumer financial services. What made this discussion between Simon and Adam so compelling, and why we're now bringing it to you as a podcast, is the moment we find ourselves in. As Adam framed the discussion at the outset, we are at a true inflection point. Data availability is at its peak. Artificial intelligence is advancing at extraordinary speed, and new payment rails from real-time ACH systems to stablecoins are rapidly maturing. These forces aren't evolving in isolation. They're colliding with one another. And as Adam put it, the challenge is separating the signal from the noise in a landscape where innovation is moving faster than ever. In this conversation, Adam and Simon dig into several of the most consequential developments shaping financial services today. First, the emergence of agentic commerce, where AI is no longer just assisting consumers, but actively participating in discovery and decision making. As Simon observed, agentic commerce is already happening, even if agentic payments aren't fully there yet. Second, the profound implications of this shift for liability, authentication, and trust, including the question of how we capture and verify user intent when machines act on our behalf. Third, the evolving reality of open banking in the US, which Simon described as both messy and vibrant, a system where innovation is thriving even amid regulatory uncertainty. Fourth, the next generation of personal financial management, where AI-driven tools may finally move beyond static dashboards to something closer to a real-time financial advisor for the mass market. And finally, the growing role of stablecoins and alternative payment rails, which Simon characterized as tiny but real, with particular traction in cross-border payments, corporate treasury, and global payouts. Throughout this discussion, Simon returns to a consistent theme. We're still in the experimentation phase. The infrastructure is being built, the protocols are emerging, but the end state is far from settled. Or, as he memorably put it, looking at early signals is critical, because suddenly in 6 months, you're going to be like, whoa, where did that come from? Well, with that, let me turn this podcast show over to Adam Maarec to begin the conversation.
All right. Well, welcome, clients, friends. Thank you for taking time out of your day and your evening to come hang out with us and talk about innovation and fintech banking. We're at an interesting inflection point where access to data is peaking. AI is being developed at a really fast pace and being deployed, and we have new payment rails that are becoming operational. And this is all happening. And these innovations and these technologies are colliding, right? All happening at one time. And we have to manage these issues and work through them and find the benefit for consumers and the market and businesses. And we also have to think about the technology and the regulatory policy that is evolving right alongside it. So tonight, we're going to try and separate a lot of the chatter and the noise that we hear about these developments, which at times feel incessant and like the pace of innovation is just so fast. We're going to try and separate the signal from the noise and figure out what's really changing, where the real innovation is happening in the market. So we've got one of the sharpest observers in fintech here to talk with us about it. Simon, everybody give Simon a warm welcome here to the U.S. Many of you know Simon from his prolific writing and podcasts on fintech brain food and on LinkedIn. I had the pleasure of going to FinTech NerdCon for its inaugural conference in Miami last year, and I told my kids today I was going to be doing a fireside chat with the head nerd of FinTech NerdCon. So here we are. But Simon's got amazing experience working on mobile banking and leading digital transformation for big banks and fintechs alike. He's an advisor to CEOs, venture capitalists, and even regulators. Yep, right. On emerging trends in fintech, open finance, and AI. So
I have opinions of people like the British accent. I think that's what it is.
It really sells. It really lands there. All right. So let's start conversation with agentic commerce. When we hear the term agentic commerce a lot, when you think about it and the impact on fintech, where you see agentic AI really making an impact today?
So far, everywhere but fintech. Not to sort of ruin the party here, but there was a good study by Salesforce that said during Black Friday, Cyber Monday, I think 1 in 6 transactions that happened were initiated via some sort of LLM or generative AI, whether that's Amazon's Rufus, whether it's ChatGPT. People are starting their product buying behavior, especially for gifts and things of that nature, in that experience. So that changes everything that happens before you press pay. And so you'll see now that a lot of the payments companies, a lot of the commerce platforms, Shopify especially, are really changing how they manage cataloging and cart building, everything right up until you hit pay. As of right now, there are more protocols for agentic payments than there are actual payments. Like it's Visa's announced one, and MasterCard has one, and Google has one, and Coinbase has one, heck, Tempo has one. It's the Oprah meme of like people inventing new payments protocols. And I think, candidly, you speak to anybody involved, they all go, we don't know how this is going to play out, but we know we can't miss out. And AI has this annoying habit of being like, okay, that's a really cool thing over there, but this isn't affecting me. It's not going to affect me. It's not going to affect me. Oh, wait, my life's over. And that always happens in a flip, and it happens in this big moment. And I think the payments companies are paranoid about that and trying to get out in front of it so that even if nobody's making agentic payments yet, agentic commerce is already happening and already here. So you can see that wave coming, but it's kind of like e-commerce. People were trying to buy things long before like CyberSource, Visa and MasterCard officially happened. Mobile tap to pay was happening and it was coming, and then it was never happening. This is much faster. This is way, way faster. And so you can wind the clock forward 12 months' time and start to think, what's the experience going to look like? And version 0 was, oh, well, you'll just use the LLM, like you'll do your checkout in the LLM. And then Walmart has cancelled that because conversion was 6 times worse than it was actually on their website. So why would you do it? Whereas Amazon, that has built their own agentic experience with Rufus, has seen conversion improve. So we don't know yet what agentic commerce really is. People are experimenting with it and trying to figure it out. It's really cool.
It's really shopping right now, right?
Yeah.
Agentic shopping, gathering information to figure out what's the
best discovery. It's like your car. It's the whole inventory management, the discoverability of that inventory, the secure protocols of what happens. Amex today announced how they're going to support agentic commerce, which is a little bit different to Visa and MasterCard that says, here's our standard on our network. What they said is, really fascinatingly, if your agent buys something and you've given it your Amex credential and it does it using the software we built, and the agent randomly buys something you didn't want, we, Amex, will be liable for that, even if it was the software's fault. Oh, that's interesting. Like, really? So we're in this phase of experimentation. It's mostly shopping, but you can sort of see where it's going.
Well, you took us to liability earlier than I was expecting. I love it.
I know my audience.
Yeah, right. So let's talk about that. What happens when? Well, maybe right before we get to liability.
Yeah, you can't help it, boys.
You're shopping. You're gathering information, but the brands are losing out on their customer experience, right? Amazon spent a lot of time curating what their user experience is going to look like.
They actively block ChatGPT and other.
Well, let's talk about that. So there was some litigation around that.
Yeah.
To block screen scraping, extracting product information to serve it into a private LLM based shopping experience, and they blocked it. Right.
Yeah, and I think open banking proves that you can block enough things to make the experience bad enough that you can bring people to the table. Sorry, I've just had this allergy for a while. And Amazon's going to play that game. They're incredibly margin sensitive, right? They're going to do that. But we don't know what the experience is going to be. So, like, who's to say it's not going to be that? The agentic shopping experience, the merchant on the surface looks like they really suffer, right? They're like, wait, so I don't see that customer, especially if it's that checkout in the LLM or in the agent. I don't see this customer. I'm commoditized based on my price. And I don't get the same data I used to get about who's this customer? Can I retarget them? Are they a fraudster? Are they clicking around my website? And you want me to accept that? Well, actually, no, that's not what's being said, but that's what all of the merchants assume because they immediately assume the issuer is the enemy and the card network is the enemy because I'm a merchant and all I care about is my margin. They assume that, but I don't think that's true. What intelligence commerce has built and what MasterCard has built and a lot of the protocols from Stripe and Shopify and Google, they're all designed to share information about the customer in like this really secure two-way back and forth channel. And so you can think of agentic commerce as a new channel, but the browser doesn't necessarily exist yet. So that's what makes it confusing. Like the mobile was a channel, the browser and e-commerce was a channel. Everyone assumed the LLM would be the channel, right? And we would just do the checkout there and we display it all. But actually, the Amazon example says, is that where the LLM lives, or does it live on the website? Does it live on my service? Do I build the agent myself? So we don't know yet what the form factor is going to be, but the protocols are being built. And it's kind of like pre-browser, you had HTTP. I think we're just in this super fascinating space where we don't know how it's going to play out.
Now let's talk about liability, right? So one of these agents gets an order from me to go and find a pair of shoes, but instead of choosing my favorite Air Maxes and buying them in a size 10, they buy a size 10, but they buy 100 of them.
Yeah.
And ship it to me. This is not the MX model where Amex is willing to stand behind what the agent's done.
Audit trail, question mark.
Are you seeing this play out, right? This is a fear that I think there's a lot of discussion about the rogue agents and managing liability that flows. But is it happening?
Oh, America, man. You guys like to worry about a legal thing that hasn't happened yet. We might be able to sue somebody.
We're just protecting our
our base. This is the most litigious place on earth. God bless you. It's why you have an economy. Look, there would be many answers to that question, right? The Visa argument would go, we're updating the network rules for dispute resolution and how that would play out. And they'll say you have to use the intelligent commerce tokens. And just to get technical for a second, the way that works is really interesting, how they put it into the authorization stream. So my agent is given a mandate by me to go buy something. Buy this specific SKU, and it can be really quite detailed. Or my mandate might be more amorphous. Go find this in my size. It then has to take that mandate and transmit it to the network when it comes to the authorization. And the merchant then checks that with the Visa network as well. And there's like a handshake of the intent the user gave me that was authorized on the Visa network by the Visa customer user. So I, the consumer, authorized it. The merchant then has what they send to the network. And if those two things match, Visa approves the authorization. So what they're saying is we've built in a lot of technological protections to it. But we all know, that we have those protections in the child networks today, and we have disputes and chargebacks, right? So they would then say, well, we have disputes and chargebacks. We're just going to update what the rules are. But it's edge cases all the way down. And having worked for Sardine for a long time, most merchants write off any chargeback below $400 because the cost of fighting that chargeback is higher than just refunding somebody. And so you get the abuse. So what I think as somebody who's worked for Sardine for a while is, cool, this makes it way cheaper to do chargeback fraud. Like I could just go use a bunch of things, say, oh, my agent did it, my agent did it, my agent did it. So it's going to be like a whole bunch of stuff we haven't figured out yet. The Google answer is, again, intense. Like, how do I capture the user's intent? And I think the tricky bit is not the protocol of like, I have this signed intent from the user and it was duly given to the merchant and the payments processor and they all saw that intent. The squishy bit is from the human to the agent to the intent. Like, how do I know what the human typed and what they meant and that was faithfully represented as an intent in the protocol? Like, that's going to be the tricky. That's where the ambiguity that lawyers love is going to need to get flushed out. I think that side is much more concerning than this side.
So it all lies with the consumer, right?
Well, Target has even come out and said, if you use an agent, it's on you. And I'm like, well, how do you guys get to decide that? Like, aren't merchants on the hook in most card schemes? Like, you own the liability, I don't. And so they're just terms of servicing it into well, yes, but if you use an agent, it's your problem.
Or if your agent equals you.
Yes. Yeah. Right. But you used an agent and it did it wrong, so you did it wrong, so you're liable. And I'm like, well, surely I'd have a refund set of protections, even if I did it wrong. Even if you fat-fingered the wrong size of shoe, generally customer service should be supporting you with that and sending you the right one and letting you do returns. So, I don't know. I think people are just proactively trying to build a wall so that if that gets pushed back, they're in a, it's like a defensive strategy coming from Target.
Yeah. Well, and so I think it leaves some room for the agentic platforms to figure out how they're going to resolve these errors directly with their customers.
And look, they played ball with the New York Times and everybody else. They'll play ball.
And just one last piece on this. Thinking about, I've had the pleasure of representing the digital identity team at a large bank and was very familiar with authentication protocols and all the time and effort and resources put into verifying that a consumer is who they say they are when they come to log in. How is that evolving to recognize agents, right? It's a different set of tools, similar but different.
KYA is a whole other beast. Know your agent.
Know your agent.
Yeah, I think we're going to get very familiar with that term. I need to write that piece. I did about 18 months ago, but it's too early. People are like, what do you mean? Sometimes my worst performing pieces are the early ones. Like, it's the market's not ready to hear that yet. You ever see the first Back to the Future movie where Michael J. Fox is playing the guitar and then he loses it in this ripping solo and the whole crowd's like, oh, you kids aren't ready for that yet, but you kids are going to love it. I think KYA is kind of in that space where it's a conversation we need to have, but so much of the industry is just trying to figure out what is agentic commerce. So knowing an agent still feels kind of alien. But I would not be surprised, let me say that much, if this was not a very hot topic in some of the large labs. And Visa has its trusted agent protocol. And there's ERC 8004, which is crypto's attempt of doing decentralized KYA of a sort, and authentication, obviously, identity and authentication, two different things, of course. But that's going to be absolutely crucial of how do I maintain the link between agent and user. And speaking to some of the card networks, and two of them said the same thing to me. 6 months ago, we thought that pre-OpenClaw, this was going to be easy because we would just KYB the agent provider and then give them a set of requirements to authenticate the end user against an existing card or token. We could build that chain. But now, if Simon builds his own agent with his own open source software, how do I know that agent? And then you got this really interesting 2x2, which is like, okay, maybe Simon's using, like, Simon is Simon, but the agent has gone bad. Maybe the Simon is Simon and the agent is being good, but Simon's a bad actor and like is doing friendly fraud. Maybe they're both bad. Like, and you can have this like 2x2 of like good agent, bad user, good human, good agent, good human, bad agent, bad human, good agent. You see, but you've got all of these new complexities of like what, but then that starts to look like commercial cards. And so this is why I think RAMP are doing a lot in the space, because they're quite familiar with that permissioning and hierarchy and the delegation of permissions and all that sort of stuff. I think that's going to need to be something that just becomes consumer grade and seamless.
Yeah. All right. So let's pull a little bit on that thread of knowing the third parties that are coming to access your systems and data. Pivot a little bit to open banking. So in the US, consumer permission data sharing has gone from a concept to a reality. It's commonplace in a lot of digital user experiences, but at the same time, and powering lots of innovation in this space. Think about AI tools that want to ingest as much data as possible to find
Perplexity and Plaid just did a partnership, right?
I saw your piece on that. Really fascinating. Next gen personal financial management, taking all that data and analyzing it, crunching it in new ways. While those services are growing, we have I call it regulatory purgatory here in the U.S., where
that's the name of your memoirs.
My head sounded sad. Yeah, jeez. How do you think about managing the variety of risks in open banking and coming from the UK and observing our regulatory ecosystem? I'm wondering if you can give us like a compare and contrast, right? What has worked in the UK, EU, maybe even other markets where
look, we have 99% coverage and availability in the UK, but I put an asterisk on the availability, which is except for planned outages, which is the biggest bullshit card that banks get to play ever. It's like, yeah, we don't work some weekends once a month. It's like, so it's not 99%. Is it 99? It should be 5 nines of uptime, or so it's technically 4 nines. But still, like, come on, guys. So the consumer experience is theoretically fantastic. In practice, because we don't have vibrant private sector in quite the same way that's willing to break a few eggs. I can't remember the last time I used open banking in the UK. I pay my Amex bill with it because they have a really nice workflow with it. I can pay my taxes with it, but it's harder than just doing a push payment. Like, because faster payments in the UK is like an ACH that's instant, and it's pre-filled from the last time I did it. So I just enter the amount, click send. There's almost very few times you use open banking in the UK as a consumer. You don't. Whereas the US, opposite problem. You're in regulatory purgatory, but I think you guys have probably all used something like that quite recently, and it's quite common. And the cash flow underwriting is an amazing innovation that we just don't have. It's technically available, but it's never taken off. It's because we had a whole issue with payday lending for a while as well, and then we had some heavy regulation to push back on that. Anything that's short-term, high APY is basically killed. So what earned wage access doesn't exist as a category. And a lot of the innovation that you've got around that is a lifeline to people. And a lot of the innovation you're getting now around cash score from Cash App, for instance, just doesn't exist. So I remember coming to the US for a few times in the early days about banking, and I'd say, like, hey, your open banking ecosystem's really interesting. And they go, "Oh, Simon, we don't have open banking here." And I'm like, "Yes, you do. You just don't think you do because it's not regulated in the same way as in the UK. But you have something far better. You have a successful, vibrant ecosystem of apps and services that consumers can use and are making a real difference to their lives. I'd rather have that thing. Like, the US is messy and it's weird and I don't know what's in the food. But I can probably go to Whole Foods enough to survive, and then that's amazing that you have this vibrancy that does it. So it keeps lawyers in work as well. It's just also I'm sorry, I'm just gonna keep pacing. But like the thing that's just not happened with open finance that we do have in the UK, which is now starting to take off, is it's generally it's becoming a new payment scheme. And Revolut's really driving that in the UK, which is an alternative to card networks. Like if the UK is not worried about its payment sovereignty in the way that the rest of Europe is, because if we needed a new card scheme because Trump woke up and got angry at the UK, and we couldn't send the king there enough to keep him happy, then we have open banking that works and we just stick a label over the top of it. Like, that payment system works, and it's better than the card networks in terms of, like, you think about the thing you get with a payment via open banking is I get to check before a payment goes, is there enough funding in the account before I send the money? Which is one of the biggest issues around ACH is, like, people will drain the funds and then initiate a transaction, and then there's the settlement delay. I can also check all of the other interesting bits of data between financial institutions, reusing those rails for fraud, which I can't do on the card scheme. Open finance as a payments rail is phenomenal, but weirdly, the DOJ made that not happen. I think if Plaid had been acquired, you'd have ended up with that becoming a dominant rail.
Where you see account-to-account payments going here, do you think there's room for it to take off, or have
there's too much of a mess?
Ability to track balances, right? Real-time authorization exists in the card networks. You have cards and debit cards to do almost exactly what A-to-A account payments are trying to do.
Yeah, you do. I think there's still something sort of magical about the higher value payment side, where your bank steps in and you see your mobile app. So the way it works in the UK is, like, if I'm making a payment, first of all, card payments tend to stop around 20,000. Anything above that, you're doing a wire, you're calling somebody, it's really going to the right place. With open banking, I can verify that this is really the right account, that is with the right bank, that's the right recipient, that you put in all the right information, that it all matches. I can give you. So I think for the high value payment space, and also for recurring payments, I've seen some banks say, especially on the acquiring side, we'd much rather this go through the A2A rails than be using cards for this specific thing. And Visa Direct is getting quite competitive on pricing to see that off. So I think for high value payments and for subscriptions, that's the area of wiggle room. But it's not setting the world on fire. Like, it's going to take something for those to really take off and be more than a niche use case. I actually think it's much more interesting in B2B, like matching it against an invoice and all that kind of stuff. That's where a better version of ACH, right? Like instead of creating an ACH instruction and having an ops and a finance team do it, you can really streamline all that stuff. I think that's where the opportunity is.
Combining all the data to come to a conclusion. Maybe before we move on to talk about stablecoins and as additional payment rails to bring into the mix, can you give just like a minute on the new Perplexity integration and like the next gen personal financial management tools? Because this is something I've been really passionate about, that we've been talking about personal financial management tools to help people run their lives, to have autopilot for your finances.
And instead of that, it's always like some pretty charts. It's mint.com, but on a mobile app.
And it hasn't succeeded, right? And even though
this hasn't not succeeded, it's just there's like 10% of people who manage their money and will use an app to do it slightly better. And if they didn't have the app, they'd have a spreadsheet. And if they didn't have a spreadsheet, they'd be doing it on a piece of paper. That's just people. The like population, 10% does that, and they're the people who use PFM. Those are not the people you use.
It's a demand side problem, right? There's plenty of tools.
But then there's like the people you want to hit are the people who don't download that app. And that are just trying to make their way through it. And those are the people that will ask ChatGPT how to get rich quick. And they will ask for a winning lottery ticket and all that sort of stuff. And so I did a conversation with Brian Demir from Plaid, and he said in the surveys they found 35% of people were having a conversation about finance with their LLM weekly. That conversation about finance is much more reminiscent to me of how you speak to a wealth manager or an RIA. It's almost not about the chart. It's not about the numbers. It's about my goals, and I'm kind of worried about this. And you have this really squishy, amorphous, natural language conversation. What Perplexity did was take your Plaid finance data to make it relevant to you. And then what they did is generate charts that were relevant to you. So it's not, I don't know if you've ever done the thing with the wealth manager where you have to give them loads of documents. And then at the end of it, you see the same charts that they show for everybody, but with your numbers in it. And then you have an interesting conversation around it. But, okay, this is a conversation I can have. And it builds charts for me based on my data, and I didn't have to submit anything. I actually think the personal finance agent is the beginning of a wealth manager for everybody else. So where Perplexity is going is super interesting. It's read-only right now. Build me a plan for paying off my student debt. Cool. Connect your accounts. Done. Like, okay, you need to do this. The next step is obviously, okay, take that money out of my account every month. And that's where open finance would be really useful, because you don't really want to set up a car subscription. You want an auto pay for that. So I could see them going down that route. And I think ChatGPT, OpenAI just acquired a company called Hero, Hiro, Finance, that did something similar. This is coming. Like, my whole point about AI is like, look at these little signals, because suddenly in 6 months, you're like, whoa, where did that come from? Look at the signals. Like, you can see this is coming if you look early enough.
So we're going to have a few minutes for questions in like 7 minutes. So start thinking, and we'll be happy to take some questions. So as we think about new payment rails, and we talked a little bit about evolution to A, what do you think about stablecoins? Help us understand what's real in the market and what's bluff, right? There's a lot of discussion about the use of stablecoins. With Genius, we have a more serious infrastructure here behind.
That was the first real payments and financial services legislative act since Dodd-Frank, right? Like of that sort of scale. Just to give you a sense of like how much of a watershed moment that was. And so you have to sit up and pay attention to that. And now the rulemaking is starting. The comment periods have opened. If you've not commented, I suggest you do if you have opinions on this subject. Particularly interested in liquidity coverage ratios of stablecoins and how that's going to affect national trust charters. That's going to be an interesting one to watch for those who are nerdy enough to care. But what's real in stablecoins? Well, the obvious answer is stablecoins are the trading pair against volatile crypto assets. So that if you sell a bunch of Bitcoin, it's much easier to get stablecoins than it is to off ramp, which takes days. I can sell those stablecoin, I can sell that Bitcoin, get stablecoins, and go buy Ethereum. Like that is still about 90% of the 35 trillion in annual volume. It's the vast majority of it. There's around about 390 billion annualized of actual payments activity. So that, for some contrast, Stripe did just short 2 trillion last year. So it's like 20% of a Stripe type of volume. Not nothing. It's about nearly a checkout.com in terms of volume of real payments. And those payments are in order: payouts, corporate treasury, and remittances. And then the fastest growing and will soon be number 3 is stablecoin linked cards. So they started out as, I'm somebody in the other side of the world, the global south. I want to hedge the Argentinian peso. I can hold on to dollars as stablecoins, and I can then get a card attached to this mobile app that I've got, and I can pay in dollars for Netflix and ChatGPT, and I can also send somebody stablecoins and get local pesos whenever I need it. So hedge inflation was the first use case, but it's not the biggest by any stretch. The biggest is B2B payments and payouts. Deal, Gusto, Payoneer, like all of these payouts companies are adopting stablecoins because I can probably make a payment quite easy to about 60 countries. It's the other 140 that are the problem. And that's why stablecoins are economically better. They're more affordable, they're cheaper. So versus going dollar to euro or dollar to sterling, stablecoins are more expensive. But if you want to go from the Malaysian ringgit to the Thai baht, then you have to come via the dollar and wait a week and a half. And being able to do that local to local, especially if you have lots of regional offices in those sorts of areas, is why companies like Deal, who pay out to those countries, or remote.com, they initially found it interesting. SpaceX, who needs to collect dollars from Antarctica and all over the world where there isn't banking infrastructure, they can do that via stablecoins. They just make it the customer's problem. You figure out how you get stablecoins, and then you can pay me. Well, it's not the internet. I can get stablecoins anytime. So I just need compatible software. It's nice and easy. And so it's this long tail of adoption that's starting to bring the volume. But in the last sort of 12 months since Genius, every Fortune 500 CFO and treasury team has been like, okay, this could make a difference for me because I operate in 190 countries. And I actually have operations that move flows in different places. And the correspondent banking system works for me here, but does not work for me here. They're all turning to their banks and saying, when are you going to support this for me? I need you to support it. That, when your biggest customers are asking you, you have to do so. So there's something real there. It is tiny, teeny tiny compared to the correspondent banking system. But, the internet was pretty small.
Do you see it growing into a payments ecosystem? Like this is for cross-border.
Yeah, but I have a different take on it, which is I think of stablecoins as fed wire for the internet. Another thing to throw at you, people talk about deposits versus stablecoins, and that's apples versus oranges. Like, they're different things. Deposits are money that does not move. They're supposed to stay still, and the incentive mechanism of a bank is to not have that money move for as long as possible so they can collect the net interest margin at the flow. So JP Morgan will let you move the deposits around all of its offices as much as you want 24/7, but you try and take that out of the bank, you're going to wait 12 hours, 6 hours, whatever, because they don't want to deposit money. Stablecoins, zero friction to move them, and they are money that moves. They're very quick, very fast moving. So your business model on that is different. It's kind of a fee model. So as you think about money that moves and you think about kind of where this starts to become real, I think the business models are going to be really, really crucial. Sorry, what was the question? I lost my voice.
Well, as you were talking about money moving so quickly, I'm thinking about the risks behind it. There's opportunity here. What are some of the risks that folks should be thinking about?
AML, and oh my God, reputational risks. If that ever becomes a thing again. Because, well, Liberty's Financial, what the fuck? Like, what is that? I was listening to Scaramucci earlier, and he was just like, he said it almost exactly the same, and we all see it. It's like, that's, like, post midterms, how do stablecoins have a fighting chance on the yield debate if all of that's happening? And I think, unfortunately, I did a piece this weekend, which is like AML will ruin stablecoins if we don't fix this in advance. Like, it's got to ruin it. And the problem is, because it is instant settlement, not instant authorization, because it's instant settlement, it's 24/7, then it's so easy to place some of those funds from an AML perspective. Yes, you have this golden source record, but if they're all anonymous, it's a golden source of nothing that it got away somewhere. I think there's some real AML issues, and the amount of cyber attacks that Lazarus Group and various Russian groups are doing on the DeFi space at the moment, it's just in a way, it's a victim of the transparency. You can see all of these hacks. There are so many citizen journalists that pull it off, but there was an example where I think 237 million was stolen through the Drift protocol, and that 237 million was then laundered via stablecoins at Circle, who have a kill switch and saw it happening, but didn't do anything for 6 hours because they were waiting to find out if there was going to be any sort of like court order for them to do it. And that is something that's quite common in TradFi, to wait. So let's not say Circle's the bad actor here, but I think in stablecoins, because there's so much transparency, you can see precisely, like, we always knew there was a lot of money laundering in the traditional financial system, but it was opaque enough and nobody had enough of a paper trail that, like, nobody could tell it was going on. You could come and show them your AML process to your regulator and go, well, here's how I stop it. This is my process. And you had no way of measuring all of the crime you did not catch. With this, you have a way of measuring all the crime you don't catch. And that is the problem. Even though it's like a really good thing, you can reputation wash stablecoins so negatively with the data that's already out there. And that's my genuine fear, is that we're actually going to have such a high watermark of AML capability, even to stand still with the financial system, because the banks will say it's got terrible AML, even though, like, they're the ones getting fined billions for it still, TD Bank, anyone. Like, but they'll do that. And then the crypto industry will say something stupid on stage with some young CEO, like, yeah, the central banks are the enemy, and da, da, da. It's like, you're not helping yourself here. I got myself the disappointed dad of crypto, because I'm like, I can see the potential. I know what it can be, but I'm just tired of having to explain that this is actually better because it looks so much worse.
That was a fascinating discussion, and one that underscores just how quickly the fintech landscape is evolving. Let me close with a few takeaways from Adam and Simon's conversation. First, agentic commerce is no longer theoretical, while payments infrastructure is still catching up. AI-driven discovery and decision-making are already reshaping how consumers interact with markets. The real questions now center on trust, how we define intent, allocate liability, and build systems that can support autonomous decision-making without undermining consumer protections. Second, identity is becoming more complex, not less. The shift from know your customer to what Simon called know your agent reflects a fundamental change in how transactions are initiated and authenticated. That evolution will require new frameworks, technological, contractual, and regulatory frameworks to manage risk across an expanded set of actors. Third, the United States continues to innovate in spite of regulatory ambiguity. While Adam described the current environment as regulatory purgatory, Simon also highlighted the strength of the U.S. ecosystem despite this uncertainty, where market-driven solutions from cash flow underwriting to embedded finance are delivering real value to consumers. Fourth, AI may finally unlock the promise of personal financial management by shifting from static tools to dynamic conversational interfaces grounded in real user data. Fintech may move closer to delivering personalized financial guidance at scale. And finally, stablecoins and new payment rails are gaining traction, but come with real risks. Their utility in cross-border payments and treasury operations is increasingly clear. At the same time, concerns around anti-money laundering, fraud, and reputational risk remain front and center, and will end up playing a critical role in determining how far and how fast adoption proceeds. Stepping back, the overarching theme is one of convergence. AI, data, identity, and payments infrastructure are no longer separate domains. They are intersecting in ways that will redefine how financial services are delivered and regulated. As Simon noted, we are still very early in the process. The protocols are being built, the use cases are emerging, and many of the most important questions remain unresolved. But the direction of travel is clear. So I want to thank you very much for joining us for this episode of our podcast to hear the in-person fintechs Next Frontier event, which featured this conversation between my colleague Adam Maarec and Simon Taylor, a true fintech giant. We look forward to continuing the conversation.